We're going to continue on with the chapter 6 handout, and hopefully we'll finish it tonight, but we'll take a see. We'll see how it goes. Okay, so let's go ahead and wait. Let me do something else here. Okay, I want to show you. I added some additional links to the email. So if you let me see this. If you go into Blackboard, they'll say your Roosevelt email link and Office 365. So I just put Word and Excel and PowerPoint in there just to make it, I don't know, maybe, quicker or easier to get to those. But anyway, so those are in there if you need to use those programs. And those are the web-based ones, obviously. Okay, let's go to okay, the handout. I think we stopped on page or problem 6, I should say.
Page 6, problem 6, yeah.
Did we actually do LIFO? I can't remember. Did we start it or no? Nope. Okay.
Did not start it.
Okay, very good. So LIFO is LIFO is kind of a wacky one in that I think I told you guys this before that the United States is the only country on the planet that uses it. It's last in is first out, and the idea behind it is that it gives a more accurate indication of income. It's theoretical. It's the people who are in economics and in finance will tell you that the latest cost is the most relevant because that's up to date. That'd be today's cost of it. And if you're going to replace inventory, if you sell inventory, you're going to replace it. You're going to replace it probably closely, at least close to the latest cost of it. And so they say, okay, that's the better number for measuring income. It causes some problems in other areas, but it's generally considered to be the better number for income. Nothing really flows this way. Usually the first one's in or the first one's out. If for no other reason, because you don't have the one. You know, if you sell something on January 1st, there's no way it was what you purchased on January 27th. Because January 27th hasn't come yet. You know, those items aren't even in the store. There's no way you could have sold those. But that's what the LIFO method assumes. So it's theoretical. It used to be more popular than it is now. It's kind of waning a little bit now, but there's still something like 14% of the publicly traded companies still use it. And again, it's considered the better measure of income. But again, it causes some other problems too. But and because the international standards you can't use it for international standards. I think that's part of the reason why it's probably its days are probably numbered. But anyway, let's take a look at it. Now the mechanics of it are basically the same as for FIFO, except for taking the first ones in, you take the last ones in. Okay, so do something here. Take this big stop out of here. And remember, we talked about this last time that when we talk about this, we say last in, first in, first out, and this out really means sold. You know, so when we say last in, first out, we mean the last ones in with the first ones that we sold. And again, this one is theoretical. It's basically you're saying that the last ones in were the first ones that you sold, so that these ones that we got in last would be the first ones sold. So let's go ahead and let's jump right in. How about? Okay, first thing we'll do is sales. And sales are relatively easy because it's whatever you sold them for.
40 units. Times price 35. 40 times 35.
1,400. Yeah. Okay. So.
1,400.
Okay, so this is the sales. Now, when you do the cost of goods sold, it's basically the same similar thing to what we did before. Again, we have the units that we sold. Oops. And that just same as up here. And so we need to find the cost for 40 units. Oops. Wrong. Now, last in, we'll say, okay, we don't want the first ones in, we want the last ones in. So looking at our inventory, the highlighted yellow ones here, which ones were the last ones in?
23 now.
Yep. All right, so these are the last in. So that's where we're going to start, and so we kind of work backwards on this one. You know, that we go from the last one going up to the where do we have to first? Okay, so now we have 50 in that this inventory here. Do we need all 50?
Yeah.
Actually, no. How many do we need? How many do we need to find the cost for? Let me put it that way. How many do we sell?
40.
Yep.
40.
So we only need to find the cost for 40 of these. So we'll take 40 of them. The cost was 23. So we don't need to take all 50 of them because we didn't sell all 50 of those. We only sold 40 of them. And yeah, so this is. And you don't need to do this step, but I'm going to do it just because I'm kind of rounding it out. So we got all the costs that we need. We got them all from this layer right here. Everything we need from that last layer, we got 40 of them. There's still some left over there, but we're going to use this for our cost of goods sold. I'm doing crazy things. Let's try this again. Whoa. Fun watching me learn how to use a computer. Ooh, isn't it? All right, so let's go to so 40 times 23.
920.
920. Okay, so this is our total cost. So our total cost of goods sold is 920. Again, we're using the last ones in. And the reason we're doing the last ones in is that this number is considered theoretically the best number on of the inventory. It's the latest number. It's the most relevant. And if we replace inventory, we're probably going to do it at $23 or something close to that. Okay. So our screws these all together. Our gross profit, again, same thing we did before. Sales 1,400. Minus our cost of goods sold. Again, these are things that are sold, you know, like the car. You know, you sold it, it left. So these are actually goods that were sold. 40 of these goods walked out the door. Gross profit is what, 480?
480.
Okay, so our sales were 1,400. Our cost of goods sold, again, this is using Lifo, the last one's in, 920. And so our gross profit is 140. Okay, coming here to ending inventory. Now we got to kind of clean this up here because we sold some of this inventory from 110. How much of that inventory do we sell? How many units?
I thought 40 units.
Yep. So we sold 40 units.
Mhm.
And so our ending units here
Will be 10.
Yep. So this is not relevant here because we don't have those 50. We only have 10 left from that layer.
Yeah.
So this is our ending inventory. Ending inventory will be this beginning.
Okay. So 80.
Yeah, you're right, 80 units. We have 80 units left in our inventory and 10 of those are at 23 and 70 of those are at 20. So I'm gonna go ahead and copy this to go down to the bottom of the page here.
But why do we have the last to be first though?
That's right.
Why are we doing the last to be first? Like last in, first out.
It's theoretical. It's if you talk to economists, and by the way, I think it's mentioned that this is only done in the United States. International standards. So if you go to Europe or Asia or wherever, they're not using these. You can't use Lifo. We use it in the United States because it's a lot. Well, we used to use it more than we do now, but it's considered a better number by economists and finance people because it's the last. It's the last amount for the cost for the inventory. And so it's considered the best estimate of what the true income is for the place. Why? Because it matches it with the current situation, whatever the current situation is. And if you replace the inventory, it's probably going to be done at close to that last in price. Now, inventory does not flow as last in, first out. So it is not something that's intuitive as to which ones you sold. It's purely a theoretical one. It's saying, okay, the best estimate of what we're going to have to replace these items at, what the true cost is to us, is the last price. And it brings up some headaches, which I'll show you in a minute here. But again, it is kind of a wacky one in that nothing actually flows in this format. Nothing, you can't possibly. Going back to our problem here.
So you're saying in the case of doing inventory, they always theoretically think of it as last price sold, you said? Just
Economists will tell you that the last cost.
the last cost
Is the best estimate.
It's the best estimate. Okay, that sounds okay.
Now, again, though, some things should be obvious here, though. Let's say that you sold something on January 3rd.
Right.
There's no way it came from this layer. It wasn't even there yet.
Right.
So it doesn't show the actual flow of inventory.
Okay.
FIFO really does. FIFO says, okay, the first one's sold. That's probably true. I mean, when you go to the grocery store, you don't see milk on the shelf for 8 months, right? I mean, they get milk in.
Mm-hmm.
So in terms of accounting, how will you know when to use the last in, first out, or when to use the FIFO?
It is up to the company to decide. It's an excellent question, and it will have ramifications on your income. When I was going through, they were kind of pushing everybody to use Lifo, and now it's kind of fading a little bit. Not a little bit, a lot. But yeah. So, but it's up to the company, the companies to decide. It used to be you'd find industries that would do it. Some industries would be FIFO, some industries would be Lifo. So, for instance, the auto industry would be Lifo or whatever, and then you go to another industry, you go to whatever. I don't know, whatever the textile industry, maybe it'd be FIFO. So a lot of times it followed by the industry, which kind of a strange thing, but that's kind of what happened. But our companies can choose though which ones they want to go with. They can't generally just keep switching back and forth. They have to stick with one once they get it. But they can choose what they. Oh wait, I have to do it.
Okay.
Let me see. I'm copying these down. Okay. I'm going to take them out completely. So it doesn't mess up my spacing. Okay, so our ending inventory. So the turquoise ones. So any inventory is really those things that are not sold. We still have them. All right, so let's see the beginning inventory. Hey, that's not a word, I don't think, is it? Units, we have 70. So this will be our total cost. So 1,400.
1,400, yeah.
Yep.
Okay, that is a very unhappy coincidence with this up here.
230.
This 1,400 for the sales and this 1,400 have nothing to do with each other. Some crazy person obviously came in here and changed my hand. I'm kidding. so 1630.
What's that?
Yeah, so this will be our ending inventory. Now I want to kind of show you something just to, I'm gonna write these down so I don't. So our gross profit was
480.
I'm going to compare this to problem number 3 or 4. And then our ending inventory was
1630.
Okay, now you'll notice that this problem, the numbers anyways, you know, these numbers here, oops. Oh, I took away my stuff. This is basically the same as these are basically the same as this one. Right, number 3. So number 3 and number 6 are, the data is identical.
Oh, yeah.
So, but
Yeah.
we're just using the first in on page number 3, and we use that. Okay, so why does this matter? Well, okay, so this gross profit is $600, and this is using FIFO.
Mm-hmm.
When we used Lifo, it was
480.
480. Yep. So the method that you use can change your income and also your ending inventory. This is get some more room up here somehow. Hey. Okay, so this 1750 is for FIFO.
FIFO, yeah.
And then I'll put it over here.
1630 LIFO.
Yeah,
It looks like the FIFO yields more than the LIFO.
yeah, and yeah, so and generally that is the way it goes, because usually prices, because of inflation, whatever the inflation is, will increase over time. And because LIFO uses the last numbers, they're using the more expensive, they're selling more expensive items, basically. You know, they're selling these ones at 23 rather than the ones at 20.
20.
So, you know, that's the assumption that's made anyways. So yeah, they generally have a lower income, and it's lower on the balance sheet. You know, this balance sheet.
So which one is good? Low income or high income on the balance sheet?
Well, and again, that's that different people will tell you different things. Certainly, FIFO matches more likely the actual flow of goods. But again, you've talked to people who are into economics and finance, they'll tell you that.
So if you have more, that means you're going to pay more tax, right?
Could be, yeah.
So
And
maybe that's why they want to use the LIFO, so they could pay less tax.
That's exactly right. Yeah, it's not, yeah. You know, sometimes companies want to make themselves look good and have more income, but A lot of times they don't. You know, if you're paying taxes, you want to look like you're not making any money. So yeah, it really depends on, that's another aspect of it.
Okay.
And they've actually done a lot of studies on companies that use LIFO and FIFO on their taxes, and, you know, overpayments and underpayments and all this kind of stuff. So yeah. Yeah, so this is, you know, again, you using the method, you will not come up with, you know, the same thing usually. And I'll tell you what, the only way you come up generally with the same thing is if you look at the first ones we did. You know, where they're all the same price.
Mhm.
If they're all the same price, it doesn't matter which one you do. You know, LIFO, FIFO doesn't matter. It's $20. So it only matters when the price of things change, which they generally do.
Different.
So, okay, now here is another problem though with LIFO, and that is the beginning inventory. If you don't sell everything out, this inventory could stick around for decades. You may have a beginning inventory that has, you know, a cost on it came from 1986. And how relevant is that today? It's not, it's ancient history, you know. So, you know,
So I think the LIFO will work best for goods that do not have expiring dates, right?
One more time.
The LIFO will be for goods that do not have expiring dates.
Yeah, but it does, but it really is just theoretical though. It isn't that the items from 1986 are still there. They're long gone. They probably left in 1986. But because we've been assuming that the last ones in were the first ones sold, the cost is still hanging around. The goods aren't. The goods are long gone.
Okay.
Yeah. So and I think that's one of the reasons why, you know, the international standards say, no, we're not doing that because we're not going to have goods sitting on the books for 30 years.
Mhm.
Now, in the time of COVID, where you walk into the store and the shelves are all empty, I mean, that, you know, it could be they sold all the way down to the beginning inventory, but you know, for most times that doesn't happen. All right, so let's take a look at the next one. My spacing here is not right. Go ahead and I tell you what. Go ahead and see if you can figure this one out.
Okay. Why is the purchase for January 1310?
That's right. Why do we go to the 13th?
January 13, why is it 10? I thought it's supposed to be 20 or something.
Well, I think we found the cost of 80 of them, right? Did I do the right number up there? Yeah, so we
No.
sold
January 13. Why do we have 10?
Why is there 10 here?
No, that one, next one. Yeah, that one. Why is
We
it
only
10?
need the cost of 10 of them.
Oh, okay.
Yeah.
I thought you were picking the one that is up there.
Well, yeah, no, so out of these 70, we only took 10 of them. Now that there's still what, 60 left in there?
Yeah.
Yeah. That'll be and then again, I'm just kind of put this down here just to show that we're done with this. Need the cost for 0. 1,000. And again, this one, is kind of the actual working of it is about the same as the last in, or first in, first out. But it's a little bit difficult to frame as to why we're doing it this way. But it's basically saying that these last ones that these ones at $30 are the most relevant. And we replace this inventory, we'll probably have to replace it at $30 or closer to $30 than say 20. these are a little bit exaggerated, but you know, the idea is the same. $1,400. Yeah, I just realized that's on there.
1,400, yeah.
Just realized this is the third 1,400 we've had in the last two problems.
Yeah.
You get that? Yes, I know the answer. It's 1,400. That's always 1,400. Okay, now we got to kind of go up here and clean this up, because from the 21st, we sold all of these. Well, these are gone. They're never coming back. From 13th,
We sold 10.
Yep. So we still have what, 60? I don't know.
Still have 60. That's 25. And 40, that's 20.
Yeah, so we really don't have these 70 up here. We don't have 70 more. We have 60.
That's right.
So this is our ending inventory. The beginning, that turquoise, and this. So those are the two layers we still have left. Those are this is what was not sold.
Mhm.
So these down here were sold, or
Mhm.
at least theoretically they were sold. And then up here, these are the ones that are left.
Mhm.
Okay, let's get you out of here. All right, so our ending inventory. Stuff that was not sold, still have them. All right, so any inventory will be 2,300.
Yeah.
Okay. Single one of these is on. I don't know why I get there. So let's go ahead. Tell you what, let's go ahead and do this one, then we'll take a break. So whenever you're done with it, feel free to take a break.
Okay.
And I will. By the way, you can abbreviate cost of goods sold as COGS. I think I told you that before.
$31.50.
350.
Yeah.
Okay, I'm gonna clean this one up here because we don't have 280 in there anymore. We sold
It's 280. That's 50.
we sold
So,
we sold 250.
yeah, 250. So we have 30.
Yep. All right, so cross this out. Oops. So we only have 30 here. Oops, too much. All right. So these are the ending. Excuse me. Hey. So those are the ending inventories we still have. We still have the 130 at 8, and we still
And
have
then
30. Yep.
30 for 10. Yeah.
So these are the ones that are actually not sold.
Mhm.
All right. So, So that's our ending inventory, I think $1,340. That's not how you spell ending, by the way.
Oh,
You know, it's bad when you hit on the, you make a suggestion, there comes up, it says erstwhile, like, what? All right, so let's go ahead and take a break. Say be back at what, 7:13?
7:13, yeah. Here.
Okay. So last thing I'm going to cover today is the average cost method. The average cost method is, okay, look, you know, whatever they cost, we'll just average that cost and use that for everything. And the nice thing about doing the average cost is that you'll use it for cost of goods sold and for your ending inventory. So once you get the average cost, that's it. I mean, the rest of it's pretty easy.
So then you have to find the average cost first and then you use it.
Correct. Exactly. Exactly. Yeah. Once you find the average cost, you use it for everything. Use it for your cost of goods sold. You use it for, you get one cost for your cost of goods sold and for your ending inventory. It, you know, before we had computers and calculators and all that, the average cost was just too time consuming. You know, it was never used because you can imagine like a grocery store, they get deliveries every day and sell stuff every day and all this stuff, all these, you know, things going in and out. To keep track of that cost would have been, and to keep averaging it, you know, would have been a real headache. So really, since the advent of computers, it's really the only time it really came about, and there are companies that use it. There definitely are companies that use it. It has a little bit of the same problem that Lifo has, although not nearly to the extent in that when you keep averaging something, the original cost from 30 years ago, a little bit of that will still be around, no matter how much you average it. Now, you know, again, over time, it'll become a very, very, you know, immaterial amount. But there is a little bit of theoretical problem with the very, very old costs will continue on forever with it. If you do programming, if you're into computer programming, average cost is by far the easiest to do because you just use two variables, units and cost. And if you look back at these other ones here, let's see where we're at. You know, if you're using LIFO or FIFO, you're going to have all these inventory layers, and each one of those layers and each one of those costs have to be temporary variables that will be there and then they'll be gone. And so you have to keep opening up new variables and new, you know, for units and for cost. And anyway, if you're doing, you know, computerizing this is real easy to do average cost. The cost that you throw in, and that's what the you know, the average cost of this would be whatever it's divided by. Okay, so let's take a look at this one. So number 9. Sales. Might as well do those first, right? Those are NG easy. Sales are never a problem. Oop.
120 by 40. One 20 by 40. 4,800.
Yep. Oh, wait, I left the 4 out there.
Yeah.
Okay, so this is our total sales. And again, the sales is you kind of picked up, I'm sure, are really pretty easy. Whatever they gave you, that's the sales. Okay, I gotta redo this handout. These are all got shifted over somehow. I wonder, is it that way in the PDF file? No, it's not. See, the PDF file is fine. Huh. Huh, how strange. Okay, well, so here's what we gotta kind of do for this one. What we're gonna do is multiply these out. This over. So I'm gonna replace these ats with
So 40 by 25, 1,000.
Okay, please.
1,000, and this one is 160. 160 by 21. 3,360 for the first one. 60 is 1,000.
okay, so what we're gonna do is we're gonna get the totals here. Okay, so give oops, what am I doing here? The available units, let's see here. 200. So we have a total of 200 units, and the total cost is 4,360. So, and by the way, this average cost method is sometimes called the weighted average cost.
So you just pick up the sales, total sales that we got and put here. You did not multiply this by anything.
Right, we're gonna get the total cost of all of our inventory. So the total cost of this inventory is,
I was thinking maybe so 200 by 40, is that what you did? Or you just put the,
just add them. These, yeah,
because this is for 120 and this is 200. So why do we put 200 for? Oh, the totals, never mind.
yeah. Now, but yeah, you're right. So here's what we're gonna do. You're absolutely right. We only sold 120. But we gotta find the average cost for all of them.
All of them, okay.
And then we will, but then you're right, only 120 will be the ones that were sold. Okay, so how do we find the average cost?
The total divided by the number.
Yep, so 4360
divided by 2.
Yep, so So 4360 divided by, let me do this. So total cost of 4,360 divided by 200 units.
Yep, 21.8.
So this is our, so this is our average cost. And again, you'll see this called weighted average cost. It really is the same. It's the same thing, but because the weighting is that we have more at $21 than we have at 25. So the multiplying it out weights this one more heavily than this one. But average cost is just average cost, to be honest with you. You'll see it called both things. Okay. So this is our average cost per unit. And this is what we're going to use for everything. Okay, so we come down here. Just like before, we have our cost of goods sold. The nice thing is, though, there's no layers. Everything is $21.80.
21.
Average cost is, yep, 20, oops. So 2,000. This one's 6.
That's fine, by. Yeah.
Again, there's no layers or anything to it. It's just whatever it is. Whatever the average cost is, that's it. Don't need all these rows here. Okay, so our gross profit will be
$21.84.
more than this. 21.84, you said?
Yeah.
So these are sales. Let's do this. And by the way, gross profit usually is right in the middle between LIFO and FIFO. You know, LIFO usually has the cheapest ones. FIFO usually has the cheapest ones. LIFO has the most expensive ones. If you average them out, this is, you know, the average will be usually right in the middle of them. Not always, but usually. Okay, and another nice thing here is so our ending inventory is the same way. Now, here's the thing though. If our units available, the total units available is 200. And we sold how many units?
We sold 120.
So this will give us our units not sold or any inventory.
That would be 80.
Yep. So this is our ending inventory. This will be our So these are not good. We still have these. We can still sell these if we in the future. And it's all going to be at the average cost.
That would be 80 by 21.80. 1744.
All right, so this would be. And that's just it. That's right in the inventory. I'll show you guys something here too. And I didn't make this point. I did not make this point before, but I'm trying to make the point now. I want you to kind of notice something, and that is this. If you take your total available units, I want you to notice how I have no idea how to use a computer. Okay, so you'll notice that now it's just getting sad. All right, so these are the units. My little dog just crashed into something upstairs. I'm not gonna go look though. So the total cost was the total cost of this $43.60. Cost of goods sold was $26.16. If you subtract those, oops, you will come out with
4360.
oops,
Oh, 1744.
1344.
yeah, it's the same number. It's the same.
Um,
And it really comes down to like, look, you have all these goods available. They're either sold or not sold. So this total cost, is gonna be, it's either gonna be of those things that are sold or those things that are not sold. And so, yeah, this is, I mean, truthfully, you don't even have to do this step here if you don't want to. If you're like me and real lazy, you would. But so so the total cost is of all of them. So the total units available. And either sold or not sold. The ones that are sold were $26.16. And so the ones that were not sold will be the rest of the money, the rest of the cost. And by the way, you can do that with any of these. We didn't multiply them out when we did LIFO FIFO because we didn't need to. We didn't, these kind of messed up now. But we didn't multiply these out because we didn't need to. And way back in the days when, you know, they had to use LIFO or FIFO that they didn't have average, there would be no reason to multiply them out. But you could multiply them out, and then if you get one, if you get ending inventory or cost of goods sold, you really have the other. If you have this total, you just need to get one of the other ones, and you can subtract it and get, you know. Okay. The last one of the night. This is the one we were looking for, this one. Be fairly quiet. And let's see if we can figure this one out.
Hello.
Okay, I think you should have got 43.
Yeah.
Dollars for the average cost per unit.
Yeah.
And so we use that for everything. Again, over here, the units sold will always be whatever, whatever we sold up here will be the same thing down here. $17,100. Okay, and we have be lazy again. Our total units available was 400. We sold 300. These are units, by the way. Okay. Now, actually, at this point, there's really two ways you can figure out the ending inventory. Or you can check your answer, you know. The total cost. Total cost of 400 units was 17,200. Total cost of the 300 was so the total cost of the 100 must be the difference between those two. 4,300. Now, I'm going to go ahead and do it down here also, though. So any inventory in units would be 100. Oh yeah, it would be. Actually, for this one, it'd be a lot easier just to multiply it up. 100 times. Again, this available units. These are the total this is the total that we could possibly sell. The most we could possibly sell was 400. We didn't sell 400, but that'd be the most we could possibly sell, the most that were available to sell. And so the question is, well, what happened to the 400? Well, some of these are either sold or not sold. There's only two options on this. You know, they're either sold or not. If they're sold, they go into our cost of goods sold. If they're not sold, we still have them. They're still in our ending inventory. And again, you can also do it with the cost as far as what's left over. You know, the $17,200 worth of inventory, 12,900 was sold. So this. Question on that? We are going to stop right here.
Straightforward.
Good, good. And again, the average cost one in the past not used so much because no computers, but nowadays, I mean, it's easy. It's actually easier. This is the easiest one to program the computers.
Yeah.
Two variables, units cost. And you don't have to figure out the cost per unit, whatever's on the invoice that you put in. So
Yes, that's cool.
all right.
All right. Tire. Thank you.
All right, and I will yeah, so next class we'll just pick up where we left off. We'll do this next class, the multi-step income statement.
Oh, okay.
Okay, guys, so we're not going to turn this one in yet. We're not done with it. So there was nothing to turn in this week. Unless you have stuff from last week to turn in. But yeah, so nothing new this week to turn in. I'll put it that way.
Thank you.
All right, guys, have a good weekend, and I will see you in a week's time.
Thank you. Bye-bye.
Bye.